So like I worked time versus before, so I was
Okay. I was working business ends kid for some individuals. I clearly navigated more towards the business side because it's
not just about, that.
Well, good afternoon. Thanks for joining us today. Appreciate your time. I'm Meg Schneider with the Greater Des Moines Partnership, and it's great to see all of you here today. And thanks for joining us for our next installment of the Top 5 for Small Business. We are lucky to have this expertise here, especially given the fact that it's tax season. It's prime season, right? Today's topic is tax reform and how it will affect your business and you individually. And this is hot off the press. So we're thrilled to have Rob here to share his expertise. So Rob is the senior accountant in the Business Advisory and Tax Services Department at McGowen, Hurst, Clark & Smith, PC. He specializes in compliance and consulting services for corporations, closely held businesses, and individuals with an emphasis in multi-state taxation. Rob is an ISU grad, awesome, where he graduated with a bachelor's degree in accounting, and he's a member of the American Institute of CPAs, the Iowa Society of CPAs, and he's also involved with Downtown Chamber and the Nevada Music Parents Group. So we're thrilled to have Rob here. Also, as we go through the topics today, you're welcome to ask questions as we're on that specific topic, and then of course we'll try to save some time at the end so we can do a deeper dive into those specific changes. So, Rob, I'll let you take it away.
Thanks a lot, Meg. Excited to be here. I want to thank the partnership for allowing us to be here as a firm. We're really fortunate to do these kinds of things. So, like Meg said, if you have questions, feel free to ask throughout the presentation. It might make more sense to ask when we're on that particular slide. So get my attention any way that you need to, and I'll repeat the question in the microphone for those online. So like Meg said, this is 5 ways tax reform will affect your business and you personally. Meg kind of talked a little bit about me. I also wanted to add a little bit about the firm I work for. We have 2 offices, one in West Des Moines, which is where I work, and then we also have an office in Winterset. We have 75 employees, and we're the largest locally owned CPA firm in central Iowa. And one thing we're very proud of is we're consistently ranked among the top workplaces in Iowa. So that's something that we're very proud of. So now let's get into the presentation. So the Tax Cuts and Jobs Act, as it's unofficially known, they couldn't put the tax cuts part in the title because it's not officially a tax cut for every single person. It's officially called Public Law 11597. This was signed into law December 22nd, 2017. It's going to change all areas of taxation. One thing that is a little bit interesting about it, in order to meet the reconciliation part of this bill, the individual estate and pass-through side of things are only effective from 2018 through 2025. So once we get to the 2026 year, we go back to the rules as they are in 2017. And then there will be some inflation adjustments. So that's kind of an interesting quirk of the new tax bill. On the corporate side, though, those changes are permanent. So here's an outline of what we'll go over today. We'll touch on 5 topics and anything else if anyone has any questions about. We'll just briefly touch on the reduced tax rates across the board. We'll go over some depreciation provisions and then some kind of other pertinent provisions that were passed under the new bill. We'll kind of spend the bulk of our time on pass-through taxation. A lot of small businesses are organized as pass-throughs, and so we'll spend a lot of time there. We'll briefly touch on Iowa tax considerations and the associated tax reform that's kind of going through the governor's mansion and the GOP in Iowa. And then we'll conclude talking about some individual taxation and how it will affect you guys personally. So just briefly, we'll touch on some reduced tax rates and the individual rates. You'll see on the next slide, but those are in your handout, so it's on the back page, so you might not be able to see that up here. But as far as the corporate side, the corporate rate was a graduated tax rate from 15% up to a maximum of 35%. Under this new bill, it's going to be a flat 21% tax rate. So just a quick example, this is for a C corporation. If you had $1 million in taxable income, in 2017 you would pay $340,000 of federal income tax. 2018, you're going to pay $210,000 on that same $1 million of income. So, just kind of the question I'd throw out there rhetorically is, what would you do with the federal tax savings? $130,000, you could invest in new equipment, hire new employees. That's kind of the hope, and the hope of the administration to kind of spur some economic growth through that. And so, like I said, this is just kind of a quick snapshot of the individual tax brackets, but you can probably see these a little bit easier on your handout. So it just goes over what the current brackets are and what the new brackets are under the new Tax Cuts and Jobs Act. All right, so we've touched on the reduced tax rates. Now let's move on to some other areas that will affect businesses, specifically depreciation. And then we'll get into a couple other areas after that. So first, what exactly is depreciation? The non-tax definition is you just think the decrease in value of something. You purchase a car, you drive off the lot, immediately goes down in value 25%, for example. The tax side of things, though, it allows you to recover that cost of that piece of equipment or car over the life of an asset. So if you have a piece of machinery, that might be depreciated over 5 years. So you buy it for $10,000, you get a deduction over the next 5 years for that $10,000. And so now let's get into kind of some specifics of depreciation. So one thing that a lot of small businesses use, it's called Section 179 depreciation. And so what this is, it allows you to write off fully the cost of the equipment in the year of purchase. So if you buy a $100,000 piece of equipment in 2017 or 2018, you get to write off that for federal tax purposes in the year of purchase. So you get a $100,000 deduction on your tax return.
But not carried, it's got to be in that year.
Yes, so the question was whether it was carried or carried forward, and you take it in that year of. There are some other limitations, though, with Section 179. You have to have income to take it. So if you're in a loss position, you can't take Section 179. So that's something to consider as well. As the rules are currently, the deduction is limited for federal purposes to $510,000. And then once you put in more than $2 million and $30,000 of equipment, then the deduction starts to get phased out. So, for example, if under 2017 you put in $2.1 million, you're $70,000 over the phase out. That means the maximum deduction you could take is $440,000, which is $510,000 less the $70,000 we were over the phase out.
Rob, if you make some purchases, but you're taking a loss that year, could you take Section 179 on that purchase the following year?
No, it has to be in the year of purchase. There are some other things you can do, which we'll get in a couple of slides, though, to take depreciation. So the new tax bill has increased the Section 179 limits. For 2018, it's going to be a $1 million deduction, and the phase-out starts at $2.5 million. So, the same example, if we put in service $2.6 million, our deduction is reduced to $900,000. So that's the amount of deduction that you can take in the year of purchase. And if you're over that, then you start to get into the other depreciation rules, which you can take in the year of purchase and over the life of the asset. So in contrast, there's this other provision called bonus depreciation. And when these two depreciation provisions were put in place, 179 was really put in place to kind of encourage small businesses to go buy pieces of equipment. If you're a large company, like any of the large businesses that work downtown, you're going to put in a lot more equipment than the phase out. So if you put in $5 million, you can't take a Section 179 deduction. What they put in place, though, it's called bonus depreciation. And so this still encourages those big businesses to put in some equipment and still get kind of an immediate benefit for that piece of equipment. So it's a little bit different than 179. In 2017 and prior, it allows a taxpayer to write off 50% of the purchase price, and then you also get kind of the regular depreciation. You get to take that 100% less the 50%, and then you get to take that amount over the life of the asset. So, quick example, you have a $100,000 piece of equipment. We'll assume it's a 5-year piece of equipment. immediately you get to write off $50,000 in the year of purchase. And then also in the year of purchase, you get to write off the regular depreciation for year one, which is $10,000. So on this piece of equipment, you would get to take $60,000 of depreciation in year one, and then the remaining $40,000 would be taken over years 2 through 5. Okay? So this is the current rules. The new provisions kind of puts bonus depreciation in Section 179 on a more level playing field. You can write off 100% of the purchase price of a piece of equipment. So in your example, if you were in a loss, you wouldn't take Section 179, but you could take bonus depreciation to decrease or to increase your loss, and then maybe have kind of a loss carry forward or something like that. So you could use this provision to write off a piece of equipment in the first year. And one thing I should have mentioned on the 179, that is available for new and used equipment. With bonus depreciation in 2017, that was only available for new equipment, but the new tax bill has changed that. So that includes used equipment as well. So that's a big deal for a lot of small businesses. If they're buying used equipment or maybe a used car, you're able to take bonus depreciation. So the same $100,000 asset, you get to take the full $100,000 deduction in the year of purchase. And so you're not taking a different amount of depreciation under the old bill or the new bill. It's just a timing difference. So now you get to take it in the year of purchase, where previously you'd be able to take it over 5 years. So, did you have questions?
Does it apply to vehicle too for the first year depreciation?
Yeah, the question was whether it applies to vehicles. There are certain rules, which we'll get into actually on the next slide, that are specific to vehicles. So this is kind of a hot topic, depreciation related to passenger automobiles. So the current rules as they're written, basically they didn't want to encourage businesses to buy these luxurious cars and be able to write that off for tax purposes. So they put in these provisions to kind of limit the amount of depreciation that you could take. So basically in year one, you could take $11,160 of depreciation on a car, and then they limited that going forward. So if you bought a $40,000 car, usually cars are depreciated over 5 years. But these rules will not allow you to depreciate it over 5 years. It'll be more like 7, 8, 9 years. So that was just to kind of encourage businesses not to buy these super luxurious cars. The new tax bill increases the amounts, though, so you'll be able to take the depreciation of a car a little bit quicker than you previously were. So now you're able to take $18,000 of depreciation on a passenger automobile in the year of purchase. And those are these kind of top 2 areas. That's for cars that weigh less than 6,000 pounds. There's some rules when a car weighs over 6,000 pounds. You can take bonus depreciation on that. So you could write off, maybe an SUV that's over 6,000 pounds. You could write that off fully in the year of purchase.
Is this if there's no notes on the vehicle or paid in full?
Nope, that doesn't matter. It's just the purchase price. And the question was whether there's a note on the car. Yep. All right, we'll get into my father-in-law's favorite term, and I also wanted to point out my mother-in-law is here, so if you have any questions, you feel free to ask her. Alternative minimum tax. On the corporate side, this was eliminated, so this is a huge deal for some companies that were subject to this. Basically what alternative minimum tax is, it's kind of a separate calculation that taxpayers would have to run to see if they were going to be paying more tax. So it was put in place in the 1960s. There was a very few subset of people that were not paying tax. I think it was only like 1,200 people. And they put in this calculation to get those 1,200 people to pay tax. But in doing so, it kind of has not really been adjusted for inflation. So it's subjecting a lot more people to this AMT on the individual side. Going forward, though, 2018 and on, far fewer individuals will be subject to this alternative minimum tax. There's a couple reasons. They raised the exemption, so each taxpayer is entitled to an exemption against this AMT tax. That's been raised to $1 million. It was much lower than that. And then also, as we'll get in later, one of the kind of separate calculations was you had to add back your state income tax, and that's going to be limited under the new bill. So from the projections that we've seen, when we prepare returns for 2017, our software kind of puts a 2018 projection together. I have not seen a taxpayer that will be subject to AMT. So that's something to think about. Interest expense might not be relevant to small businesses. This provision only applies to companies that have $25 million of gross receipts or more. But just wanted to show a quick example, and I know this is using $1 million in gross receipts, but just kind of wanted to use round numbers. So basically, in 2017, you're able to write off your interest expense in full. So you have debt that you're incurring to pay your employees or buying a piece of equipment. You get to write that off fully in 2017. So in our example, we have $1 million of income less salaries of $800,000 less interest expense. We have $100,000 of taxable income. 2018, those same numbers, it's going to be $140,000 of taxable income. And like I said before, only applies if you have more than $25 million in receipts. Just wanted to put kind of an easy to understand example up there. A few other provisions before we move into the pass-through side of things. Like-kind exchanges. So this was popular with vehicles. So if you had a vehicle in your business, you would maybe trade that in for another vehicle, maybe a newer model. What the current rules state is that's not a true disposition for tax purposes, so you don't have to pay income tax if there's a gain on that property. Now they've gotten rid of that, so they're going to treat that as a disposition for income tax purposes. The like-kind exchange rules are available for land and buildings, though, so they're keeping it to the longer-lived assets rather than the shorter-lived vehicles or tractors or things like that. The domestic production activities deduction, this is a tax break for U.S. manufacturers. It was put in place in 2006. It's caused a lot of angst. There's a lot of taxpayers that take this that shouldn't, and so the IRS was auditing this a lot. That was eliminated under the new tax bill. And then net operating loss carry forwards. If you incurred a loss in 2016, you were able to fully take that loss. You could carry it forward to 2017 and offset your 2017 income. Now they're just going to limit that carry forward to 80%. So that could be a little bit of an issue with certain taxpayers. All right, so next we'll move into the pass-through side of things, and this is where we'll spend the bulk of our time. So we'll first go over the business entity types. So I have 5 listed here: sole proprietorships, partnerships, limited liability companies, S corporations, and C corporations. Do we have any small business owners in the room? Do you know how you're organized for tax purposes?
We're an S corp.
S corp. S corp.
Yes.
Yep. So S corporation is really popular. There's a lot of tax reasons to be an S corporation. What an S corporation and partnership and the LLC, how those work, all the income and expenses from that business is passed through onto the individual's return who owns the business. So for 100% S corp owner, they're going to report 100% of the income expenses of the business on their personal return. Sole proprietorships, those are Schedule C businesses, as we like to call them. There's a separate schedule in your individual tax return called Schedule C, where you would report that income. And then a C corporation is the only non-pass-through entity on this list, and they're different in that they pay tax themselves. So on a pass-through, the owner is responsible for the income tax. A C corporation is responsible for income tax on the business side.
So the C corp, is it going to be double taxation still?
Yep, so there's a question about double taxation. Yes, there is still a double taxation issue because your net income on a C corporation is taxed, and then if they give their owners a distribution or a dividend, the owners are also paying tax. So they're paying tax on 2 levels, and that did not go away. But with the lower rate, it's going to have much less of an impact. Yep. And so the best entity type that we've kind of seen is historically been an S corporation. Going forward with this reduced corporate rate, there's some discussion about whether certain companies need to be switching to a C corporation from an S. So that's something that I would talk through with your accountant, but it's a discussion worth having. So now, kind of the most complicated area of this new tax bill, and I'll try to make it as simple as I can, but feel free to ask questions if I need to clarify on something. It's this thing called the Qualified Business Income Deduction, or QBI deduction as I'll be referring to it. So what qualified business income is, it's your non-investment income from your business. So what you do on a day-to-day basis, your income and expenses, that is qualified business income. So if you have a bank account or stocks held in your company, that's investment income. That is not this QBI. That is not QBI. So non-investment income from a pass-through business that you own or someone else owns. So in its simplest form, the deduction is equal to 20% of your qualified business income. So quick example, if you're a 100% owner of a business and that business has $300,000 of non-investment income, in 2017, you would report all that $300,000 on your individual return. In 2018, if you do qualify for this, and there's caveats which we'll get into, if you do qualify, you'll report $240,000 on your tax return, which is $300,000 times 20%. That's a $60,000 kind of almost phantom deduction that you'll get on your tax return. And so, $60,000 times 30% or 35%, that can save an owner of a business $25,000 at the end of the day. So, and we'll go through kind of a more numerical example to kind of illustrate how much tax savings that you can see. But this is going to be a big deal for S corporation owners or partnerships or limited liability companies. All right, so now let's get into the nitty-gritty, and I apologize if I get too technical, but this stuff kind of excites me because I'm kind of a tax nerd. But basically what this deduction allows, it allows for a deduction of 20% of your qualified business income, but it's the IRS and Congress and all the lobbyists that go into this, so it can't be that simple, right? That's why I have a job, that's why my firm exists. So they put in a lot of rules to calculate this deduction, and we'll try to go over those in kind of easy to understand language. So the first test, if you're married filing jointly, if you have less than $315,000 of income, you automatically get this deduction. So that's it, $315,000. You take that income from the business, you multiply it by 20%, that's your deduction. If you're single, this $315,000 is halved, so it's $157,500. And so we've met, one of our partners met with a client, and he said the best piece of advice that he could give them for tax purposes is to get married. So it can be a big deal, especially if you otherwise might not qualify for the deduction, which we'll talk about later. The second test, or the second test is a two-part test. Are you a service business? And so this is where there's a lot of kind of vagueness, and there's guidance that needs to be issued from the IRS, and they're working on doing that hopefully the next few months or over the summer, but everything moves a little slower in Washington. So are you a service business? And there's a specific code section that it kind of points to. But a couple of the catch-alls that are a service business, consulting, and then kind of the biggest catch-all is the principal asset of your business the reputation or skill of one or more of its employees. So that could, catch a lot of people. And so if you are a service business under this code section, your deduction is either reduced or it's eliminated, and it depends on your income levels. But if you are a service business and you're below this $315,000 number, you still qualify. So that's why the first part, you can stop if you're under $315,000. The kind of part 2B, or the third test, if you will, if your taxable income on a married return is greater than $315,000, then you're going to need to know the wages allocated to you from the business, and then also kind of the fixed asset or your capital expenditures allocated to you. So, and the property, the unadjusted base of property, we won't touch into that too much. That's not going to affect a lot of people. If you're in a business owner that's paying wages, the wage calculation is where you'll be impacted. And we're talking about, it's going to be box 5 Medicare wages. So that will be the wage number you use for this calculation.
Does this apply to all companies, including C Corps?
Pass-through companies, not C corporations. And so the reason they kind of gave this tax break to pass-through companies is they lowered the corporate tax rate from 35 to 21. They wanted to give a tax break to these small business owners that are organized as pass-through companies. And so the deduction, this is where we get into a little bit of algebra. There's a minimum and then there's a maximum within that minimum. So it's the minimum of 20% of your qualified business income, or, and then the greater of 50% of your W-2 wages, and then we'll just kind of ignore that last part, but it's basically if your company does not pay wages, that's where this last line might impact you. Yes?
So just to be clear, if I have a service business
Mhm.
and my taxable income is less than $315,000, it doesn't matter that it's a service business.
Correct.
It's still good to go.
Yep, the question was whether if you're a service business, if your income is less than $315,000, you're good to go. You don't need to worry about the wage limitations or anything like that. Yep, that's correct. And so you would take your income times 80%, and that would be what's reported on your income tax return. Yep. All right. And so let's get into kind of a numerical example. And my mother-in-law might recognize these names, but I picked my brother and sisters, and they're going to be our guinea pigs for the next couple of slides. So we're going to assume Tim and Lindsay are married, and Lindsay is a 100% owner of an S corporation, and we'll assume it's a non-service business. And so it's a pretty successful business. Lindsay has $600,000 of non-investment income from this business. Since it's an S corporation, she can be an employee. There are different rules if you're a partnership, but she can be an employee of that S corporation. She takes out a $100,000 wage, and then she has a couple of other employees where their wages total $100,000. So total wages paid out by the business are $200,000. The unadjusted basis of property, which it won't come into play, but we'll say it's $200,000. Tim, Lindsay's husband, has $75,000 of wages from a separate business. He's just an employee. And then they have itemized deductions of $55,000. So their taxable income that they would report in their 2017 return is $720,000. And I get to that $600,000 plus $100,000 of wages, plus Tim's wages of $75,000, and then we subtract their itemized deductions of $55,000. So 2017, that's their taxable income. That's what they're paying tax on in 2017. 2018, though, we have to do this qualified business income deduction calculation. And you can see how much of a difference this will make in the next couple of slides. So first test is taxable income above the $315,000 number. Yes. So let's move to the next test. Are they a service business? We already assume that they are not. So let's move to the third test. So on the third test, we need to know the W-2 wages paid by the business, since Lindsay's 100% corporation owned. Then we also need to know the unadjusted basis of the property. And so now here's where we get into the numbers. So the first part of that calculation, we have to figure out what 20% of the non-investment income from the business is. We said the non-investment income was $600,000. 20% of that is $120,000. So that's the first part of the calculation. Then we need to know the greater of the wage and kind of basis test. So basically we're going to kind of ignore this unadjusted basis line. 50% of W-2 wages, remember the business paid out $200,000 of wages. 50% of that is $100,000. So at the end of the day, it's the lesser of $120,000 or $100,000. So now taxable income in 2018 for doing the exact same thing that they did in 2017 is going to be $100,000 less. It's going to be $620,000. So you think of $100,000 times maybe a 35% tax bracket, that's $35,000 in federal tax savings just from one year to the next for doing nothing different. So this is going to have a huge impact on things. Does anyone have any questions on this? Any clarifying questions before I move to the next slide?
It's going to have a huge impact for a while.
Yes, this is only in place for 8 years. Yes, you are correct.
What do you predict after 8 years?
It depends on what the new administration is, if they extend. So some of the Bush tax cuts were temporary, some were also permanent. Those temporary provisions were made permanent, so that could be the case here, or a new administration comes in and they want to repeal all this and write their own tax bill. So who knows at this point, but it depends a lot how the next few years go and how the federal budget does after seeing these tax cuts.
Sure. And the bigger the company is, the bigger the numbers are.
Yep, exactly.
The bigger of an impact.
Yep, no doubt. All right. So you notice that we use the lesser of those two numbers. And so this is where there's kind of a tax planning opportunity. And so this is where you get with your accountant maybe in December, and you can save some meaningful dollars just by kind of manipulating the system a little bit. And this is totally legal, but it's just kind of interesting how this works. So notice we use the lesser of those two numbers. So now, what happens if Lindsay pays herself an additional $25,000 in wages? So it's December 21st, 2018. She kind of has an idea of where her income's going to be at. She gets with her accountant. Her accountant suggests that she pays herself $25,000 of wages. So now the income of the business is going to be $25,000 less, and then they're also going to be on the hook for $2,000 of payroll taxes. But then Lindsay's wages are going to increase by the $25,000. So the only difference in Lindsay at the end of the day is this $2,000 of payroll taxes. So now, in the same slide, we have $573,000 of this qualified business income, which was our $600,000. They paid an additional $25,000 of wages, and then they had the payroll tax of $2,000. Lindsay was now paid $125,000. So the business paid $225,000. We'll ignore the property. Tim has the same income. Itemized deductions did not change, and we'll get into why they didn't change later. So now their income, their taxable income, $718,000. So the only difference is the payroll taxes at the end of the day. So now we go through the calculation, and I won't bore you through the numbers, but we get to a deduction of $112,500 at the end of the day. Taxable income after this qualified business income deduction is $605,500. That's $14,500 lower than it was in the previous example. And that's for paying themselves an additional wage. So there are some interesting things that you can do with this calculation. And this is totally legal, and this is how the rules are written. They're encouraging companies to pay wages. And Lindsay at the end of the day is really the same except for those $2,000 of payroll taxes. She owns 100% of her business. At the end of the day, she still has the cash in her business, or it's in her name. It's all the same. But her tax bill is going to be probably $5,000 lower just for paying herself an additional $25,000.
Does it always have to be through wages, or could you do it through other benefits, say employee benefits programs, 401k matches, long-term care offerings, any? Does it have to be wages?
So the question was whether it had to be wages or it could be through other things. So the 401k match program, that would not go into the wage test. The employee themselves would have to put into their 401k because the 401k is an increase to box 5. But you could also do it through, if you were subject to this kind of second part, you could maybe put in some more capital expenditures and kind of increase the deduction that way. But it has to be through wages if you're just talking about the employee side. So at the end of the day, Lindsay's basically identical, but she's going to have $5,000 in lower tax.
So Rob, would that more incentivize them, the company owners, to pay more in salary versus more in fringe benefits?
Yes, definitely. The question was whether it would encourage them to pay more in salaries versus fringe benefits. Yes. Mm-hmm. And so
there's some deductibility changes on the fringe benefit side, even
yes.
as well, like deferred comp. And
Mm-hmm.
I'm not sure if you're going to touch on that or not, but I find that pretty interesting.
Yep, there are. And Lindsay doesn't have to pay herself in this example either. She could pay her other employees, and she would still see some of the savings as well. So, all right. I know that was a lot to throw at you. Does anyone have any questions? Yep.
Were you going to touch on the changes in expenses, rules about expenses and entertainment versus?
I can touch on that, yep. So they've changed the way entertainment expenses are treated. So in the past, those were always 50% deductible. So if you have tickets to the iCubs or to the Iowa Energy, for example, you would get a deduction for 50% of the purchase price of those tickets. 2018 and going forward, you get no deduction. So those are 100% disallowed for tax purposes. You're still welcome to do it. You just don't get a tax benefit.
What about an educational meeting like this that the company pays for?
That would be a training expense, so that would be fully deductible, yep. I hope you don't think I'm entertainment. If you are, a little weird.
So it's all how you categorize it.
Exactly. Just don't let your accountant know exactly what it was. And then there were some other rules related to meals. One of the big kind of changes for meals was in the past, if you were having the meal for the convenience of your employees, so they're working late and you say, I'm going to order pizza for everyone and everyone's welcome, those meals were 100% deductible. In 2018, that same meal is only 50% deductible. All right, so now we'll briefly touch on some Iowa tax considerations. So 529 plans, this is a great way to get a deduction for your children's education, whether that be college. Now with the new bill, that extends out to primary and secondary expenses. So if you have someone going through private high school or private grade school, you can use those monies for that tuition. Except I will warn you, if you go to the Iowa website right now, they have a big pop-up that says, don't take distributions to pay your primary or secondary education. I think they're still working through it right now, so just be wary of that before you do. But that's a federal law change, so that allows those monies to be paid for those primary and secondary education. Depreciation, Iowa only allows $25,000 of Section 179. So remember I told you that the federal limit was $510,000. So if you took the full $510,000 in the federal side of things, you would actually get no deduction for Iowa because you would be above this phase out. So that can be an issue for small business owners. Basically what it means is your federal taxable income would be lower, but then your Iowa taxable income would be a little bit higher. One thing that I found interesting, there's this first-time homebuyer savings account that I think the realtors kind of helped get through the bill, a recent bill, but basically it allows a deduction for first-time homebuyers. If you're single, $2,000 on your Iowa tax return. If you're married, $4,000. So if you're renting, looking to buy a home, you can start a savings account with a bank, and you just get with your bank and they'll help you. You get a deduction on your Iowa tax return. And then the interest from that savings account is also free from Iowa tax. And it doesn't just have to be you. Say you had a mother-in-law or something who lives in Iowa. They could start an account for their son-in-law and daughter. They could get a deduction on their return too. So if you have kids, you're more than welcome to open a savings account for them. Just that money has to be used for their future house. And you can do this up to 10 times. So if you're married, you could have $40,000 to use towards a home purchase. So I thought that was kind of interesting. We'll touch on the Iowa tax reform side of things, with all this federal tax reform, Iowa's got to respond a little bit. One of the big things that Iowa has going against it is they kind of have a high sticker rate. So 8.98% is the highest Iowa income tax rate. That's a lot higher in relation to some other states around. But what we do have, we get to deduct our federal income taxes. And so to kind of simplify the code, they would get rid of that federal deductibility. They're going to phase that out, and then they would lower the individual rate to kind of offset that. A few other provisions, they would allow 25% of that qualified business income deduction. And this is Governor Reynolds' proposal. And her proposal does not have any bearing on C corporations. It's just on the individual side.
Likelihood of passage?
There most likely will be something done. Whether it gets done for the 2018 tax year is going to be interesting. But something will get done probably for the 2019 year. Most likely 2018, we'll wait and see. The Senate released a similar proposal. There's a few differences. Their rate's a little bit lower. They would get rid of federal deductibility. They would allow 20% of that federal qualified business income deduction. But with this one, I think I read that this was going to add $1 billion of debt to the state every year. So there's going to have to be some kind of meeting in the middle on both sides to kind of try to get that close to zero or reconciled a little bit better, because $1 billion is a lot to add to the debt of Iowa. All right, and we'll conclude the presentation kind of talking about individual side. So this is going to affect you personally. Even if you're not a small business owner, this will affect you. So first, we'll kind of talk about itemized deductions versus standard deductions. So basically, as the laws are written now, if your itemized deductions are more than this kind of set dollar amount that's called the standard deduction, you get to take an itemized deduction on your tax return. Itemized deductions are made up of medical expenses, state income tax withheld from paychecks, your real estate taxes, personal property taxes, kind of vehicle registration, mortgage interest, investment interest, and then donations, and then there's always kind of an other category. So currently, the 2017 standard deduction, if you're married, that standard deduction is $12,700. So if your deductions on the previous page are less than $12,700, you're going to use this standard deduction. You'll get a $12,700 benefit on your return. If they're more than $12,700, you get to take that number. And we'll go over an example here. But then, as you see, the 2018 standard deduction has been greatly increased. It went from $12,700 to $24,000. So, and I apologize for this slide. It's a little, might have to squint a little bit. But you might think if your deductions are over $24,000 in 2017, well, I'll be fine. I'll keep itemizing. I'll get a full tax benefit for my charitable donations, my mortgage interest. But that probably is not going to be the case. So in our example, we're going to assume that this person has about $23,500 made up of state income tax, property taxes, and their real estate taxes, about $3,300 of mortgage interest. They donated about $1,400 of charitable contributions. So at the end of the day, they had $28,262 of itemized deductions. So that means in 2017, since we are greater than that $12,700 number, this is the number we're going to use to reduce our income. However, 2018, so this is kind of a close-up of the state and local tax section. That line 9, which was the bulk of their itemized deductions, line 9 is going to be limited to $10,000. So, they had $15,000 withheld from their paycheck. That's going to be capped at $10,000 for your deduction. Your taxes will still be withheld, but you'll only get a benefit on the federal side of $10,000. So that means these people's real estate taxes and their vehicle registration, no tax benefit at all for them. So if we look at this same taxpayer with the same expenses for 2018, their itemized deductions are only going to be $14,000, $14,723. So that means they're going to use the standard deduction in 2018. So I think currently, best estimate, probably 30% of people itemize their deductions. Next year, that might be more like 10 or even less percent. So this is going to impact a lot of people.
So Ralph, quick question then. So if I'm looking at these tax brackets here, so if you're single, you're just going to shave off $12,000 on the income here as a standard deduction.
Yep.
Which could definitely change the bracket that you're in.
Exactly.
In the tax you pay.
Yep, no doubt. A few other kind of, so this was just kind of a summary of the various, the example we just went through, $28,000 in total. Standard deductions, $12,000 in 2017, so they're obviously going to itemize. But in 2018, we're going to flip to the standard deduction using those same numbers. So even though this person might be hurt a little bit for their itemized deductions, if they have children, which we'll get into in these couple of slides, they'll probably be better off. One other thing that they did, so they got rid of personal exemptions. So this is another, it's kind of after the itemized or standard deduction, $4,050 per person. So a family of 4, this reduced your taxable income by $20,000 roughly. That's going away, partly due to the increase in standard deduction, and then partly due to this child tax credit. So no more personal exemptions. However, far more people will get this child tax credit. So currently, tax credit's worth $1,000 per child, qualifying child that's age 17 or less than 17, excuse me. If you make more than $110,000 if you're married, then the credit starts to phase out. If you're over $140,000, you get no credit in 2017. 2018, though, the phase out bumps way up to $400,000. So you'll get this $2,000 credit per taxpayer. So if you think about it, your income tax in 2018 actually might go up, but then your credits will also go up. So then on a net position, you'll probably be better off if you have children, because you lost the benefit of having an exemption for them, but you get this added benefit for a child tax credit.
So use some of that salary increase to buy some more children.
Yeah, exactly. All right, so this is kind of the few slides that we've gone over, the various topics. If anyone has any questions, I'd be happy to entertain them. But once again, just want to thank you for spending the time and kind of bearing through this new tax law. It's pretty interesting for folks like me who kind of dig this stuff, but it can be overwhelming. So we're trying to do our best to explain it in an easy to understand way. So if you have any questions, feel free to jump in and let me know.
So a general question, so one general question in 2 parts for the business side and the individual side.
Yep.
One piece of advice you'd give to a business owner to make sure that they're doing for 2018, and the individual to maximize tax, or to maximize efficiency of the income they're earning.
So on the question was one piece of advice we would give to businesses, and then one piece of advice we'd give to individuals. The business side of things, in December of 2018, December of this year, get with your accountant. You'll probably have a good idea of what your income will be. And this is for pass-through businesses. Get with your accountant, kind of give them your financials, give them your projection for where you'll be at the end of the year, and then see if there's anything you can do with that wage number to increase that deduction for a business owner. Individual side, not a lot that you can do differently. If you have the same income and expenses in 2018 as you did in 2017, most likely you're going to be in a better position 2018 with the lower individual rate and a lot of times that higher standard deduction. There were a lot of things that people did at the end of 2017. A lot of people prepaid their real estate taxes, or kind of one provision that they threw in there was a donation for the right to purchase tickets. So I have Iowa State season tickets. I had to donate, I think it was $500. In 2017, I got a $400 deduction on my tax return for that as a charitable contribution. 2018, I don't get that anymore. That's 100% disallowed because I'm getting a benefit. I'm getting the right to purchase tickets. So a lot of people prepaid those. So not a whole lot you can do differently in 2018, but most likely you'll be in a better position.
Okay. Either you've answered everything or we're all still processing, like,
Yeah.
okay, what does this really mean when I get back to the office? So
Yep.
maybe some of both. But thank you very much for,
Mhm.
for sharing this insight with us today. Lots of interesting things to consider throughout the coming months for sure. So thank you for
Yeah,
that.
thanks for having me.
Do want to call attention to a couple things on your table. One is the surveys. We would love your input on today's session, but also other topics that you would like to have us curate for you and cover in the coming months. We absolutely welcome your input on that. And then just pencil in our next installment is April 25th, and the topic is the top 5 things to know when you're leasing a space for your business. May is, we're going to talk about websites, and then June is another HR topic. So we'll look forward to seeing you at an event in the next couple of months. Thanks again for your time. Have a great afternoon.